So just to elaborate a little bit more on how mortgage insurance works. So yes, it's an insurance premium and it gets added to the loan. In my experience, we don't need to go into the nitty-gritty details of this with the client, just simply that mortgage insurance will apply. They'll get it, they'll understand it. It's every time you borrow more than 80% of a property, mortgage insurance applies. We will do our best to remove it altogether if we can get a high enough valuation on the home that they live in, but often it's unavoidable. Okay. Key to remember though is that the mortgage insurance, when it's for investment purposes, is actually tax deductible. So it's not going to be something that's going to hold a person back from going forward, and it allows them to get into a property now rather than to wait until the property goes up in value. If you wait till the property goes up in value, that little $5,000, $10,000 that you were trying to save on mortgage insurance, you've lost by effectively $30,000, $40,000, $50,000 of capital growth. What I'm going to step you through now is the formula and the process of when you're sitting in front of a client. So the first thing you're going to do, you've already been given a spreadsheet which has got their financial information on it. So we want to confirm that that information is correct. We want to confirm what is the home value worth? What do you owe on the home? Which bank is it with? Whether or not the loan is fixed or is it variable? What is the interest rate? And it doesn't matter if they don't know what the interest rate is, because later when you get the statement, you'll actually be able to find that out. That's the first thing. We want to confirm any other debt that they have. And at this point, we find it pays to ask some very in-depth questions. Do you have any credit cards? What are the credit card limits? Do you have any personal loans? Do you have any salary sacrifices from your pay slip? Are you paying off a car through your actual employer pay? Confirming all of that information, and we write it all down. Make sure that we're getting a full picture of where they're financially at. So adding on to that, we also require what their wages are. So we confirm it if they're self-employed. Obviously, we get copies of their financials to be able to figure those out, and that's fine. Email them through and we'll come up with that. If they're on normal wages, if there's overtime, if there's anything else, ask them if it's been consistent. We want to know how long they've been in the job for. This allows us to be able to overall put together what their ability to borrow is. So often, once again, that information is going to be on the spreadsheet before you go out there. It still pays you while you're out there to reconfirm these things. We also want to know things that may seem irrelevant, like what their superannuation balance is, okay? What their savings statement balance is, who they've banked with in the past, if there's a bank that they don't like or they had a bad relationship from, if they have any credit defaults or they've had credit problems or credit defaults in the past. By gathering all this information together, it allows us to put together a really clear picture on how we can go forward with their lending. Okay, so as we're going through the appointment, really our overall goal is to get them to the point where they're going to agree to do an application. They're not going to be signing an application on the spot, but we need to get all of their financial info. So we've grabbed the pay slips, grab the home loan statements. In a lot of cases, they won't have them on board. It is worth spending that little bit of extra time while you're out there and just getting them to print them off, getting them to email them to you as a PDF. I wouldn't suggest that you let them do it on their own. I would sit there in their home for the next 10, 15 minutes to be able to get it done. So now they've got to the point where they've got all of the actual information, it's important at this particular point to take the pressure completely from them. We're not about pushing them towards getting the actual property sale. We want them to do it only if they want to do it. And this is the point where we'll use it, what we call a takeaway close, where we'll say, at this particular point, we don't even know whether or not you can get the finance. You're not committed to the loan application until you physically sign the mortgage documents, they go across to the bank and the loan settles. So at this point, it's just an application. It's just to see whether or not you qualify. The key word here is qualify. If they do not qualify, if the loan doesn't get approved, guess what? It doesn't go any further. If the loan gets approved, unless they decide that they want to go ahead, they are not locked into the purchase. And there's something that a lot of people get a little bit confused about. But hang on, I've been approved for the loan. Aren't I locked in? The answer is no. They are only committed once the mortgage documents have been signed.